Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter again, see what people are talking about, see what the news is about. It's going to be financial topics, wealth related, commodity related, or financial markets related. I'm going to dive in there, give you my financial opinions, and we're going to start right now. So we're going to go right into it. So again, if you want to follow me, it's at finding_finance. And if you want to join the website, finding-value.com, to see how I'm playing the commodity bull market that's coming, you can obviously join and use the word discount in the coupon code. So it says, I got a DM from a guy making $160,000 a year, but he's having troubles with saving and investing. Any suggestions for him? This person writes, does he want financial freedom? If so, get clear, what total assets, total liabilities, total net worth, total expenses, current return on investment, inflation rate, how much needed to invest in order to generate enough to cover expenses, allowing for inflation, what a shortfall is, and agree to a strategy. I've been chasing this for a pretty long time. Financial freedom. Financial freedom is that FU type money that people talk about, where you can go to a job and say, look, I don't need this job. FU, I'm out. I'm maybe there, maybe not. It's difficult to know exactly what that amount is. My expenses vary based off of having children and what they decide to do to some extent, because I would like to help them on their journey of whatever journey they want to partake in. So I'm erring on the side that I need probably a lot more money than what I have an idea that this would spit out, so to speak. So, I'm pretty frugal on everything that I spend for myself, and I would say a lot less frugal on the opportunities that my kids could potentially have. If they want to do some sort of sports and it travels some, I'm not going to say no. I'm going to say, you know what, let's do it. So I'm going to give them the opportunities, and if I have to spend a little bit more money, that's fine. And if I have to work a little bit longer for that to happen, well, it's not their fault that I wanted to have them, but I want to support them. I want them to do things that have a very enjoyable life when they're a kid. So that may disrupt this, but I do save a lot of money. I save probably between 20 and 50% of my income, and that has increased over time. I used to not save that amount. So if you were to look at it, when I lived with my parents for a little bit, just for a little bit, I saved money for a house, or I should say a condo that I purchased when I was really young. I bought that, got a really low payment, started saving money, save. And as the years progressed, I do YouTube here. I've got the website. I still work, and I've got dividend income that's also kicking way up. So I continue to save and save and save more, and hopefully that snowballs into larger and larger savings. And those savings will, I guess, give me more savings in the future, those dividends. And my costs have gone up a little bit. If it was just me and my wife, it's pretty low costs. And then, kids kick it up, they eat, they have things that they want to do, places they want to see. So it does kick up some, but that's the way it is. So Logan says, give the Housing Bubble Boys 2.0 some love. Their commitment to this relationship is epic. So they say each year is different, but here are some reasons they gave for home prices to crash over the past 11 years. 2012, shadow inventory. 2013, higher mortgage rates. 2014, QEs ending in October. 2015, manufacturing recession. 2016, home prices got back to the bubble high. 2017, no good reason. 2018, 5% mortgage rates, start of the bubble crash for sure. 2019, home price growth was cooling off. 2020, COVID-19. 2021, mortgage forbearance. 2022, 7% mortgage rates. 2023, historically low housing demand. But guess what? Prices continue to surge higher through this entire area. Why is that? Low inventory. There's no homes. There's more demand than there is supply, irrespective of any of these things. And guess what? It will remain robust until the inventories come back. Bloomberg curse. This is what this person says: offshore rigs close in on $500,000 a day as oil boom returns to the sea. I don't think that's necessarily the case. I do think that we could have a potential slowdown that we're going through already. Are we out of it? I don't know if we're out of it yet, but obviously getting closer to that, pulling out of that recession whenever that does come. I think that we are kind of where 2000, 2001 is. Interest rates go up, then the markets slow down to some degree. They flush out the crap out of the system. And then if they were to lower rates again, or even just keep rates where they're at, I think we're going to continue to have prices remain resilient because of the demand supply imbalance in housing. That is going to drive oil prices and all these other things higher when more liquidity comes back into the system. So that's where the shortages are at, and that's where the demographic is going to be driving these prices higher. It's demographic driven. And I don't think that they can necessarily stop that boom with interest rates alone. So here's the Sprott Physical Uranium Trust. He goes, the Bowl update held the final wave in the pennant as the truncation I was looking for, and now popped that upper band and recovered the bowl as hoped for. I don't, okay, whatever. It's this bowl that this guy has. I'm going to call it the Super Bowl. So we are playing in uranium the Super Bowl here. And right now we're riding on that Super Bowl, and hopefully we can move all the way up to, yes, 220. That would be awesome if we got to 220, guys. But it's looking good. I'm not necessarily part of the Super Bowl here, but I do look at the breakout here that we just recently had. Nick says they're between a rock and a hard place, the Federal Reserve is. It's a very, very tough situation. You're damned if you raise rates significantly more and put even more pressure on the banks, but you're damned if you don't and inflation accelerates. This is Fed Chair Jerome Powell finds himself in a place no central banker wants to be, working to avert a credit crunch, which calls for looser monetary policy, while fighting high inflation, which demands the opposite. That's what I said in 2021, I think, 2021. These guys would get in a really tough spot where no matter what they do, they're kind of screwed. So there's no good answer here. They're screwed either way they go. Totally agree with that statement. Canadian real estate prices versus income. So this is growth in real home prices, real disposable incomes, and population. This is Canada. We got the one hump, two hump, and then the accelerated move over income and population. Then you look at the United States and you say, okay, we've got the one hump, the two hump kind of back here. We accelerated up and pulled back, and maybe we're somewhere ready to launch to the upside. We do not look like we're in a bubble compared to Canada. We do not look like we're in a bubble compared to a whole bunch of different countries around the world. Does that mean that we're not in a bubble? No, it doesn't mean that we're not in a bubble. It could just mean that everyone else is in some super bubble. But we're not as overvalued compared to incomes versus a lot of other countries. And I would say that the United States has much more favorable interest rates and loans in terms of 30-year fixed rate loans than any of those other countries have. So I actually think that we're far better off than all the other countries for not having a real estate crash. They are much more susceptible to a real estate crash. It says, in the past, a significant decline in oil prices has been a good indicator of an economic recession in the United States. So sharp decline in oil price has historically marked a recession, oil prices and U.S. recessions. So I think that this will come down. We've obviously seen it come down a good bit. Now we're looking for when's the turn. And a lot of people, they're going to be calling for lower and lower and lower oil prices, or lower, bigger recession, bigger crash, bigger whatever. I'm not in that camp. I think if the housing market remains resilient and construction employment continues to go up, I don't think we're going to get a huge crash. So I think that this is going to be similar to this move here. So this move here is going to be this move here. It's going to be even a similar fractal as this thing comes down. Maybe we've got a little bit more to go before we start heading on higher. So that's my guess. It says banks have been rapidly tightening their lending standards. These are levels last seen in 90, 2000, 2008, and 2020. I think that we are in the year 2000, 2001, something like that. Each one witnessed a recession. So we could have a recession. Yep, definitely possible. I think that it's similar to probably 2000. And even though this can come back down like this, it's not going to be some sort of huge crash. And this doesn't necessarily mean that it's going to be a gigantic crash. Just means that banks' tightening standards are pretty tight and that they could loosen over time. And I think that will happen. They got very tight in 2000, then they really loosened them up during that recession, and they came way back down. If we get that loosening of the loosening of credit in the system, I think we are going to blow up a gigantic bubble in real estate. That's what I think is going to happen. If interest rates were to come back down and they were to loosen standards in loaning, it's going to be a bubble. I don't think we're in a bubble right now. So Mark Cuban claims going woke is good business in aftermath of Bud Light disaster. He's wrong. Big companies are going woke because of principal agent problems, not because it's good for their shareholders. The one thing I wanted to comment on here, and I know a lot of companies are going woke, I don't want to make a comment about that, but Bud Light, if they could unwoke themselves and actually get out of that, I think their company could come back. It's possible. I'm not going to jump into it anytime soon. I got to see a good base and a good turnaround. But if they could actually turn it around, it could be a good investment in a year or 2 or 3 or something like that. It's possible. So here's uranium. So this is UX1. That's the commodity versus natural gas, the ratio here. So I find this ratio very interesting. Thoughts? I'll give my thoughts. I think that we could see in the short term uranium outperform natural gas. And then I think natural gas, if the right conditions come, we could see natural gas just rocket. Why do I think that? Because we've got inventory, but the inventory is missized to the flow rate that natural gas is being used in Europe. So if any problem occurs in Europe during the summer or the winter, their inventory compared to their flow rate is not properly sized. They need to have much larger inventories than what they have today, given the flow rate that natural gas can flow to them. So we could see a super spike at some point if there's a problem with the weather. We could see a super spike if there's a problem with supply, with a hurricane or something like that. So I'm just kind of sitting in some of these companies, natural gas companies. I'm going to start to acquire even more and just wait for that condition to come. And then I will sell when it does come and the prices adjust way higher. And I'm not playing it with natural gas directly. I'm playing it with the equities and the companies. So URNM Daily broke the minor resistance line and have now reached the upper resistance with good volume. Possible retest of minor resistance before we hopefully break out for the downtrend. He's got it tight, up here. I've got mine much tighter than this on the closing prices. If you do the closing prices, you have a breakout. If you do these ones where you hit like these weak top areas, it's not really much resistance where we're at. We're going to blow through that. That's my guess. Could we come back up and then kind of do a retest? Very much possible. But I think uranium looks absolutely excellent. That includes the ETFs. It includes Sprott, Physical Uranium Trust. It includes everything. Everything looks really good. And the valuations are really good in uranium as well, and the equities. The commodity and the equities. It says, do not fall off your chair. This silver chart presents a setup you're not going to see many times during your life. Sentiment reset, priced coiled, ready to explode for silver. So it says, you tell me if this is bullish for silver. This is the silver price in dollars at the top. It says this breakout was special as silver and gold were bottoming and breaking out versus the U.S. stocks. It broke out in 2004. And what I'm proposing is that we're similar or getting similar to a setup that is early 2000s. And then we're going to get a big move, a big move. We also can see of the MACD that we're getting an extremely bullish MACD cross here, where we could see positive moves to the upside. It says move above this line followed by a strong move. And we're right at that line coming across the 0 point. If you look back, we've got a lot of resistance levels for this line going across here. And we're about to break that line to the upside. This is a very big deal. And silver could move dramatically. Same with gold. And even platinum could tag along. I think that a lot of these commodities, they're going to start breaking out of these patterns, and then they're going to start moving. And eventually everyone's going to FOMO into it. I've been into it since 2020. A lot of them I've been adding along the way. I'm pretty patient, and I'm ready for early retirement. So that's what my goal is. It's to get up into quite a bit of money. I'd like to get in the tens of millions or something like that. That'd be really fun. And that is when I would say, okay, I'm good. I'm good to retire, and hopefully that happens in my 40s. And that's going to be fun. It's going to be fun. And all these charts are indicators of a large, big picture view that is telling us something. And it's telling us on a time frame that we have to adjust our time frames to. You can't have a shorter time frame than what the market has. You have to have the time frame that the market gives you. You have to move and adjust to the markets, not the markets adjusting to you and your swipe left 10 seconds, 10-second attention span. It's not going to cut it. This is going to take some years, and it's going to be one heck of a ride. And guys, ride this thing with me. You can subscribe to this to the website here, or not really the website, but you can subscribe to the channel if you'd like, and you don't want to pay anything. Subscribe to the channel and just watch this stuff. Learn, watch all these charts. Get in there and say, you know what? Let's try doing some charts myself. And obviously, I'm going to continue to go over this stuff and describe what I'm seeing with all the charts that we've got. But the opportunities here, guys, they don't come often. How can I say this? Don't mess this up. Don't mess it up. Because I messed it up in the last bull market, and I was late to that bull market. I wasn't early. I'm not early like I was now. I was really young, just graduated college, just started making money and watching these stocks fly. But I had no idea what I was doing. What you got to do is if you see these things start to break, you just accumulate and then you wait. It'd be like watching this in the year 2002, and you start accumulating for a couple of years, and then it breaks and goes all the way up. You know how much money you make on these moves here, especially if you position correctly and you've got the correct companies. It can change your life. Even if you're younger and you're kind of just accumulating, it's going to feel weird because when this thing bounces around down here, when it bounces in this areas over here, you're going to be going up and down, up and down, up and down. And your account's going to go up 20, your account's going to go up, it's going to go down. You could be down 20, 30, 40%. It could be up 20, 30, 40%. And it could change rapidly with the volatility. When we break out of this thing, then you're going to know why it was worth it. When we break out and we start moving, you're going to say, oh my God, this is what it means. This is what this guy means by this is worth it. Because when it goes, you're going to see your account do things that you haven't seen. We're in this big consolidation period right now and a slowdown in the overall markets. But I think it's coming where we're going to hopefully everything kind of breaks to the upside. So we got Scotty, and again, this isn't Scotty doesn't know. This is Scotty does know. Scotty does know. Breakout even when drawn conservatively on URA. URA breaking out. He took the tops, barely skimming the tops, and we're breaking to the upside, guys. What does that mean? It means that the path of least resistance is higher. It doesn't mean that we go straight higher. Doesn't mean that we moonshot. Doesn't mean when Moon is saying that we're going to win Moon right now. What he's saying is that we're breaking out of the trend and that downtrend is changing to an uptrend potentially. I would definitely say we're in an uptrend when we make a new high. So the definition is you break out and you make a new high, you have a pullback, you create and make a new low, and then you break that high that came out past this downtrend. Obviously, I'll go over it if we happen to do that. You can see it on the daily technical analysis charts that I do, but I'm watching this. I'm already in it massively. As big as I'm willing to allocate to the sector, I am fully allocated and I'm ready to roll. And keep in mind, guys, too, your allocation. Let's say I'm exposed to 4 or 5 different sectors, and if it's 5 sectors, I'm 20% in each sector. Let's just say that for the math, for easy speaking, for easy math. You don't need to win on every sector. What you need to do is you need to win big on a few. And if you win really big on a few, it's going to carry your entire portfolio and really give you those returns. But if you're in a very cheap sector, and they're all cheap, the ones that I'm in are very cheap, if they all take off, holy crap, I'll be sitting good. And holy crap, you'll be sitting good, whoever's following all this. But it's going to require patience. They're not all going to go up at the same time. They're not all going to do the same thing. They're not going to all go up the same way. And some of the companies are going to eat SHIT, which is super high intensity training. They're going to eat some SHIT. Some of them are. They're not going to be winners. The goal isn't to have every company be a winner. I mean, that is the goal, but they're not going to be. It's not the way. Crap happens, and maybe one craps out. Maybe one of the exploration companies has a problem, whatever it is. Maybe a developer can't get their mine going. Maybe something happens to it. Maybe Russia takes out your company that you're in. It happens to everyone. But you don't need to win on every single one. Even though that may be the goal, it's realistically not going to happen. But your wins are going to be so big, it just doesn't matter. But you're going to have to ride those wins big enough and long enough for it to be worthwhile. You can't take profits too early. You got to know the entire bull market. You got to know when to sell. You got to know when the assets are overvalued. You got to hold on and wait until it's a decent selling point. And I think people who make 100% gain, they're going to be like, oh, I got 100% gain. Let's sell out of this. Well, I mean, that might be too early if you don't know when to sell. I mean, if you've got a Ferrari that's worth $250,000 and that's the value of it, and you bought it for $30,000, is it a good deal to sell it at $60,000? Well, I would say no. And then let's say a market condition comes where the car gets priced to $300,000. That's the time to sell, when it starts to get above the value of that thing or that asset. So you left a lot on the table. And that is where I think I'm hopefully going to hold long enough where I get the majority of the move. Hopefully. I hope for that for everyone. So coming on down, it says CCJ, a measurement of target. So this is for Camco and uranium. So this is John. Nice little breakout here. We're coming up. We had a little consolidation here in 2021, 2, and we're breaking out in 2023, and hopefully we can get a massive move to the upper line. So what he did is he took this line, and then he projected this one up here and said that this is a good actual location. I actually agree with about where that is. Even if you were to do a fractal analysis from about here to the top, so you come up to the top, you pull back, and then you do a fractal analysis, it gives you a price somewhere in that range. So I do think that that's probably a decent area to think that this could potentially go to. And it can get up there quite quick. So $30 to, upper 100s, lower 200s, yeah, that's definitely possible. Let's hope that's the case. Eric Nuttall says, I think the physical market is telling us something. I think the futures paper market is telling us something else. Also said the chasm between the two markets should narrow within this month. Hopefully the month after, which lines up with our projected inventory draws of over 300 million barrels in July and August. The market needs to see it to believe it. So right now, the paper market's telling us, we're going to get a recession, reduced demand. What Eric is saying, look, these cuts haven't even hit our inventories yet that they've done. It's coming in June. It's coming this month. We'll see what the inventory levels say. And then when the inventory levels start to draw down, then the price will come. That is what I think Jeff Curry thinks. That's what Eric Nuttall thinks. And that's what a lot of these guys are talking about. So we need to wait. We need to be patient and see what this market brings us. In the meantime, if the market goes down and the equities are cheap and they look like they're holding up and they're at support, maybe I'm going to fire off a couple of buy orders. I haven't done so, the past week or two, but I'll fire some off. I'll let you guys know on the website. Obviously, I'll do the updates, and I'll let you guys know what I'm doing. But right now, I'm just kind of sitting in a holding pattern, waiting for a little bit of strength in the market before doing that. Here's one. It says, finding value finance. This is how in 200 years, the property cycle history, how bank and financial companies find ways to propel property prices higher into the winner's curse phase. People who don't study history will keep calling recession, and the markets continue higher and higher. So what he's talking about is Rocket Mortgage's RKT new program will allow home buyers to put as little as 1% down on the home in the U.S. Thoughts? And he's completely right. What they're going to do is they're going to loosen lending standards. So we're going to come into this large demographic where the demand exceeds supply. They're going to loosen lending standards. And right now, they're very tight on lending standards. That's what this chart up here that I was talking about earlier, they're real tight on lending standards like 2020, 2008, 2000, 1990. They're very tight right now. They're going to loosen those standards. And when they come down, this was 2000, when they come back down like this and they loosen those standards, that's where the market peaked, was in 2005. We had a bunch of inventory starting to creep higher here. We're going to go through that same cycle. I think we're in 2000s just like we are today. Why do I think that? Housing starts are in the same spot. We've got low existing inventory just like 2000. We've got tight lending standards like 2000. All of these things line up like the early 2000s. So I believe that we are in the early 2000s and we are going to get a large move to the upside in commodities. It's going to be epic, guys. It's going to be epic. Will it happen immediately? Probably not. We still need to get through a little bit more garbage in the system. But you need to have the long-term mindset so you can accumulate assets at a very cheap price. I am ecstatic that we still have prices as low as we do in a lot of these assets. It means I can accumulate longer. And then eventually, hopefully, we can get to some pretty big numbers at the end of the bull market for the account. Fingers crossed. Coming on, I talked about that. Encore Energy, also fully bullish. Yep, breaking to the upside. This thing looks fantastic. I think I talked about this last one, so we'll end it there, guys. So that's what's going on, guys. I think we're probably early 2000s. We are coming into a tightening area, tightening credit standards, tightening interest rates. All these things are tightening. It's slowing things down. They're going to loosen it up at some point, and then boom, there we go. Now, that doesn't mean that the stocks can't go higher. Doesn't mean that uranium's can't take off. It can take off. Doesn't mean that any of these. Oil can still take off as well. We're just waiting for that inventory to start drawing down, and we've drawn down a little bit, but not enough, I think, to make a clear conclusion that the market thinks that we're going to start, continuing to tighten inventory. So we just need to be patient here. I'm spread across what I think are the cheapest sectors. Uranium, oil, nat gas. You can look over, there's some diversified mining like base metals, precious metals as well, and some of the mining companies in the precious metals area. I'm kind of spread across all those: platinum, silver, the physical metals themselves. And all I need is a few of them to really take off. And then I'll be like, okay, I'm sitting good. That gives you that FU type money. Fingers crossed, guys. But yeah, that's the market conditions. When I look at everything, they look like we're in the early 2000s, which is a good thing. If we were to compare to the mini bull market, I think this bull market's going to be bigger. I think it's going to be more like the 1970s. Why do I think that? The 40-year downtrend break in interest rates. I think interest rates are going to go higher than what most people think. And I think that we're earlier in the real estate market than what most people think. You can also see that the home builders are breaking out of their gigantic patterns to the upside, which is more data, more evidence that we are in the early 2000s timeframe, that interest rates are going to have to remain higher for longer, and that a big demographic is going to come through here and with a wrecking ball of inflation, just like the 1970s. So fingers crossed that all occurs the way that I think it's going to occur. And if it occurs the way I think it's going to occur, we'll hopefully be patting each other on the back, saying that we've held through the slowdown here and made it to the other side where everything starts to really take off. All right, guys, we'll end it there. Give me a thumb up. Subscribe to the channel. Subscribe to the website if you'd like. I'd love to have you a part of the community. And we do have a question and answer session coming up at 5 p.m. Sunday, Mountain Standard Time. All right, guys, we'll catch you later. This is Finding Value.